and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
The market had been focusing solely really on the employment side as inflation had been coming down. Now I actually think inflation is going to become front and center again, especially as we know with President-elect Trump's policies that really are likely to be inflationary, add to the deficit. And the market, after yesterday's breather, is now really, I think, set to continue to power ahead, especially as we head into year end.
But I think I've got to mark up the probability of a no landing scenario where the economy's firmer and inflation is somewhat stickier. In certain respects, that's good news. I'm happy to have a strong economy, but that path back to 2% is looking more challenging than I thought it would be.
Those have offshore manufacturing is watching the tariffs. I mean, historically, Trump has had the impact on the tariffs. So I think that's something our manufacturing sector is watching. People that want to make investments in their home are excited to have some stability and the election behind us. And I think we're going to see that activity really ramp up in Q1.
We got 1 hour to go until the market close. So let's take a look at the major averages here. Not seeing much change. Really, stocks come in down towards the lows this session, although we weren't up that much of the highs. But of course, recall, if we see substantial enough gains in the coming days after this rally stalling out, we're still near records, I guess is what I'm trying to say here. The S&P 500 also very little change to the upside. The Nasdaq very little changed to the downside. The Russell 2000, which had been outperforming large caps, now underperforming today. So again, a little bit of a pause in some of the recent trends that we've been seeing. We're also looking at what's going on with yields here, which have been less. I mean, the overall trend has been upward, but we've seen more volatility within bonds in recent days, certainly.
We also got that economic data today, the CPI print, basically came in line. I think it was a noisy print, but if you stripped it out and kind of looked at the underlying trend, investors trying to gauge out what they took away from that. I think certainly some economists saying they looked at the underlying trend. It still looked well above kind of over time what would be consistent with Jay Powell's 2% target. Big questions, what does it mean for the Fed, how it informs their next moves.
Yeah, does it complicate their moves? And another asset class we have to check on today is Bitcoin because it's at a record today, coming down off the highs of the session, but still above 90,000 for Bitcoin. That momentum has not slowed, which has been remarkable. And then quickly, just to look at the sectors, Josh, that we have going on in the market today. We've got energy doing the best today, up 0.9% along with real estate. Utilities, though, not that usual necessarily to see real estate and utilities go in opposite directions because they're both interest rate sensitive. So interesting to see that action today.
All right, let's get more perspective on this because consumer prices rose as expected in October, keeping the Fed on track to potentially lower interest rates again in December. The latest inflation data showing progress, but still remaining above the Fed's 2% target on an annual basis. For more on what this does signal for the economy, let's bring in Citi Chief U.S. Economist Andrew Hollenhorst. Andrew, it is good to have you on the show. Let's start there with that CPI report, Andrew. What did you make of it? I know there was plenty of noise there, but you look at the underlying trend and you see what ahead?
Yeah, I think when you look at the underlying trend, you do see inflation that's cooling and probably on track to cool back towards the 2% target, at least cyclically. That's going to give the Fed a runway to keep policy rates headed back towards neutral rates of interest. So I think although this inflation report, if you annualize the monthly number, you're coming in a little bit above the 2% target. If you look at core PCE inflation on a 6-month average basis, that's at 2.3%. So the Fed's pretty close here, and you're seeing things like shelter prices that are cooling, non-shelter services that are cooling. So a lot to really build the Fed's confidence they can keep cutting in this report.
It does feel like the shelter, though, is the sticky thing. Yes, it's cooling a little bit, but not by very much. We know that mortgage rates are not coming down by very much either. So, what does that path look like? Where's that easing going to come from?
Yeah, that really has been a challenging part of the inflation story. And of course, the challenge for the economy is the high price of housing and high mortgage rates. Minneapolis Fed President Kashkari talked about this today, and what he said is the same thing that I would say, is that if we look at where rents are coming in now, and inflation as we measured in the US is based on rents, those new rents are rising at a much slower pace. And when you look at the official inflation statistics, that's looking at rents that are resetting maybe from a year ago, 2 years ago, 3 years ago. And we know that those rent increases are going to converge to the slower pace of increase that we're seeing now. So what Fed officials like Kashkari are saying is that we're really looking backwards when we look at that official data for shelter inflation. If we look at the current on-the-ground facts, we're already seeing softer shelter inflation. So I think they can kind of look through that in the near term.
Do you see, Andrew, next year, do you see the Fed taking a pause here?
I don't know that they need to pause. I think they'd probably at least get down to 4% policy rates before they would really seriously think about pausing. What Chair Powell said last week at the FOMC press conference is once they get in the range of where they think neutral rate might be, they might want to be a little bit careful about, are they going beyond neutral? Where exactly is neutral? There'll be a whole conversation next year about where that is. But I think at least for December, for January, they're probably on track to just keep cutting rates.
The other thing economically that's getting as much, if not more attention right now than the Federal Reserve, unusually, is the election and the results of the election. And yesterday at our Yahoo Invest conference, we heard from Joseph Stiglitz, of course, noted economist, and he sounded a little bit more cautious on the outlook here. So I want to listen to what he had to say.
We are in the soft landing, but it ends on January 20th. And that's when we start getting into a harder place where we don't actually know where we're going to go. That uncertainty, by the way, is not good for the economy.
So, that uncertainty is not necessarily being expressed by the market, right? The market seems to think pro-growth policies, everything's going to be great. What do you make of what Stiglitz is saying is that, and that element of uncertainty?
Yeah, I think there are still some questions that need to be answered about what exactly policy is going to look like, and I think we'll get some of those answers in the coming months. I do think that there's been a tendency to maybe put a little bit too much weight behind the idea that the Federal Reserve is not going to be able to cut interest rates because of what's going on with policy. Yes, deficits are large. They're probably going to stay large. It's not clear that there's going to be policy to address that. But maybe the biggest piece of fiscal policy that received attention in this election is continuing the tax cuts from 2017. If you continue an existing tax cut, that's not adding new stimulus or new inflationary pressure to the economy. That's just continuing fiscal that's already there. If you allow those tax cuts to expire, that would actually be a restriction on the economy. So I'm not as worried about new stimulus that's going to boost inflation. And then you turn to tariffs, which is the other thing that's getting attention. And Minneapolis Fed President Kashkari commented on that today. We're going to hear from Chair Powell tomorrow. Let's see if he says something about it. But the first move for central bankers when they think about tariffs is to think about that as an increase in the price level. And I know we kind of talk about a price level change versus inflation. What's the difference? The difference is, do you think it's going to continue? Do you think it's something that continues? And
is it a one-off or is it something that's going to be consistent?
And that's what Kashkari said. If it's tit for tat, if we have countries that are raising tariffs on each other, it's more of an inflation risk. Maybe that's hawkish for the Fed. But if it's just a one-time rise in the price level, I'm not sure that's hawkish for the Fed.
Can I ask you, at the top of the show, we were talking about what we're seeing in the financial markets, just the rip we saw in the stock market. Bitcoin is really working. I mean, how as an economist do you think about that? Because we've been talking about an economy that's, we use words like it's decent, it's hanging in there, it's resilient. But when you see moves like we're seeing in the financial markets, as an economist, does that indicate to you, well, hold on, maybe it's not just resilient, maybe we're actually are we warming up here?
Yeah, I think you want to be careful about reading from the equity market what's going on in the economy more broadly. And that has kind of been the story of this economy, that if you look at the largest corporates, if you look at the wealthiest individuals, they're doing very well in this economy. If you own a house, you have a low rate mortgage and your house price has gone up, that's a great place to be. Maybe you own equities and the equity prices have gone up as well. If you're an individual that is renting and your rent has gone up and you're making payments on a credit card and that credit card debt has a floating rate associated with it, so you've seen that rate of interest go up, or you're trying to become a first-time home buyer and we're talking about high home prices and mortgage rates that have actually moved higher since the Fed started cutting, you're really getting a tale of two economies in a way there. So I would see what's going on in financial markets much more about what's happening for the wealthiest and the largest corporates and maybe not representative of the economy as a whole.
I wanted to go back to fiscal policy and what we could expect here. Of course, we've all been talking about the new Doge, not coin, government agency or extra governmental agency that is the one that has been going to be headed up by Elon Musk and Vivek Ramaswamy to try to cut from federal spending. Now, I was taking a look at federal spending as a percentage of GDP because it does contribute, of course, to GDP. Right now, it's around 20%. It's come back down towards sort of the longer-term trend. So how much is that a concern that they'll cut away some of the GDP, or are we relatively confident it's going to be made up for by some of the other sort of, again, stimulative policies?
Yes, I think this all goes into the category of questions that need to be answered. There's probably going to be a large fiscal bill that comes out at the beginning of the Trump presidency, the new Congress, with Republicans controlling the Senate, likely the House, using the reconciliation process to pass that. And it may come down to a slim majority in the House, with just a few Republicans controlling that majority. Who are those few Republicans? How do they feel about spending restraint? That may be a question that we're asking. So I do think there are questions to be answered still about what the size of that fiscal is. Again, I would emphasize maybe the single biggest fiscal issue is this extension of the tax cut, which is not going to be new stimulus.
But it's not counted in the deficit calculations yet, is it?
It's not counted
in the estimates.
Exactly. So when we look at the deficit, that's going to be a number that comes from the Congressional Budget Office. They're going to assume that those tax cuts that sunset, according to law, sunset in their forecast.
Right.
So when you extend that, those deficit numbers will be bigger. So there is a deficit debt issue in the U.S. At some point, it needs to be dealt with, and that will have economic effects when it is.
We'll talk about that next time, Andrew. Thanks for being here. And probably the time after that and the time after that. Thanks, appreciate it.
My pleasure.
We're just getting started here on Market Domination. Coming up, a new high on the street. Oppenheimer raising its year-end target for the S&P 500. We'll discuss with Chief Investment Strategist John Stolfus. That's next. Plus, Elon Musk and Vivek Ramaswamy will lead a push by President-elect Trump to make the government more efficient. More on what that move could mean for government agencies. And we'll take a look at today's trending tickers, all that and more when Market Domination returns. After the U.S. presidential election cleared an overhang of uncertainty, some on the street believe markets now have even more room to run. Oppenheimer's chief investment strategist John Stolf is recently raising his year-end S&P 500 target to a street high of 6,200. This is the third time he's done that this year. John Stolf is now joining us to discuss. John, it is fantastic to see you. I got to see you yesterday in person at our Yahoo Invest conference, which was a treat, and now it is a treat to speak to you again. So what led you to this increase? Because obviously we have seen a lot of enthusiasm post-election in the market. It sounds like you think that momentum is going to keep going.
Yeah, well, great to be on the show, Julie, and very much enjoyed the conference yesterday. And when you said you thought I might be on the show today, I thought I was on the road today. I'm on the road tomorrow, but I've been basically in meetings throughout the day. It's been a very hectic time of year. But we will say, related to our target price, last December, I think it was December 11th, we put in a target for this year for the S&P 500 of 5,200. By March, and it was the highest on the street, or we may have been tied, I think, with Tom Lee at the time. And then by March, we had to raise it because our discipline is if it closes at or above our target, we have to review it and decide if we're going to raise it or whatever we're going to do. And we moved it at that time to 5,500. In July, we went to 5,900. And then we were sort of waiting around, letting the market had some vacillation there in terms of where it was going. And then it broke through the 59 and went to 59.98, I think, is where it closed the Friday before we went to that Monday, raising it to 6,200. And we think it's driven by S&P 500 second and third quarter earnings growth and revenue growth have outperformed expectations. Consensus expectations were looking for much less growth. And then the Fed has been remarkably successful thus far since March of 22 through a process of 11 rate hikes and 9 pauses at the higher end of their rate of not pushing the economy into a recession. And then, it's been a case of, if you look at it, it's been business, the consumer, and jobs have all proven resilient, even if slowing somewhat as a result of the effects of the Fed going after inflation for over 2.5 years.
So what would be, John, though, on your wall of worry? If I was to push you on concerns, would it be, would it be valuation, John? Would it be sentiment, both?
Well, always you've got to watch sentiment and you've got to watch valuation. In terms of valuation, we think a lot of the things that are driving valuation are we've seen concerns about valuation then being essentially ameliorated by improved earnings as the quarters of this year were reported. And then also we have seen that the private investor has become more committed to equities over I've been in this business 41 years. I've never seen quite like this. Investors today, the private investor is more like an institutional investor that is intermediate to long-term mandated. And it could be that people are looking at Social Security and concerned about and the lack of pension plans that are defined benefit. Now it's all it's essentially a defined contribution kind of plans. The thought is people are investing for their retirement, for their kids' education, perhaps for their legacy, what have you. And in that, it causes an investor that is more likely to either buy the dips, or we'd prefer to say they buy the babies that get thrown up with the bathwater when the market pulls back, or when it's just rotating and rebalancing. When traders are moving in and out of stuff, that's when you find a lot of opportunity a little bit cheaper than you might have just a few weeks before.
Yeah, certainly that has been a powerful force to kind of at least provide a floor, at the very least provide a floor into the market. Obviously, it's done a lot more than that. One of the other risks that we have been hearing more about recently is the idea of so-called bond vigilantes with the deficit climbing and expected to climb further under this Trump presidency. And I don't know if you heard my conversation yesterday at Yahoo Finance Invest with BlackRock's Rick Reeder when he talked about that potential threat. I want to play for you what he said yesterday, John.
Markets tend to react to the shark closest to the boat. The shark on the debt dynamic is not going to be next to the boat in January, February, but it is going to get next to the boat sometime. I don't know if it's the latter part of 2025 or the beginning of 2026, unless they address, and by the way, unless they address the size of the spending dynamics, the amount of debt we're issuing, and then obviously inflation relative to that.
Now, none of that seems to be part of the discussion in Washington right now, John. Is that a risk scenario where you see the size of the debt becoming such that you see bond yields really start to go much higher? And has that become an obstacle for stocks as well?
I can't help but think that, like Rick was saying, it's not one of the sharks that's closest to the boat at this particular time, but is likely out there somewhere in the water and is likely to surface at some point, but probably not until at least 2026. I think 2025 will be mostly looking at what the new administration puts into effect and how that might affect the economy. The biggest problem now for years has been both sides of the aisle have spent money considerably more than they probably should have at different points, whether it was fiscal stimulus or other things that fed into constituencies that politicians try to work with, so to speak. We can't help but think that, this is something that voters really need to address. I think one of the things that, I as a baby boomer was taught is you should always vote. But no one told me that whether it was the person that I voted for who got elected or whether it was the person that I didn't vote for who got elected, if I didn't like what they do, I should write them a letter, I should send them an email, and I should get 5 of my friends to do the same thing. It's essentially, I think the electorate has to become activists for both sides of the aisle to begin to address the problem. I think near term, the reality is it's more, what was it that Bill Gross used to say, if all the countries in the world are dirty shirts and a hamper full of dirty shirts, we are the cleanest dirty shirt among those dirty shirts. And you've got to figure the alternatives in terms of sovereign debt or fiat debt. The U.S. stands out because of our accountability, our transparency, governance, and also our capability to innovate and the size of our economy at around $28 trillion. But there's no doubt about it. There has to come a point where we not only address the amount of debt that we've taken on, but also our ability to cover that debt payment without derailing or at least challenging our economic growth. But I do think I think that the American people need to become activists, much like the activists in the market. If you don't like what the company's doing, tell them about it and get the vote. Throw them the vote, and you can begin changing things.
John, always great to see you and to have you on the show. Thanks for joining us.
Thanks, Josh. Thanks, Julie.
Thanks.
Now time for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up today, let's check out Amazon, e-commerce giant rolling out its new online shopping service, Amazon Haul, which is meant to compete with Chinese low-cost retailers like Temu. Amazon Haul will focus on selling items for $20 or less. The new service is available in Amazon's shopping app and mobile website. So available, it sounds like, in beta version right now. Described as an engaging shopping experience, Julie, that brings lower priced products into one convenient destination. I saw apparently it's going to charge $3.99 shipping fee that's waived for orders larger than 25.
Yeah, and it might take longer to get stuff than people have become accustomed to with Amazon, but they are accustomed to it if they shop on those other Chinese-owned platforms. Now, Amazon, of course, has a history of taking over, like basically anything it sees as a competitive threat, it either buys that thing or it does that thing itself. And in many cases, it does it very successfully. So I guess the only surprise here is that it's taken it as long as it has to face the competitive threat that is Temu and Shein and some of these other low-cost companies. We'll see how it ends up working out if they have the same sort of shopping experience and catch on in the same way.
To your point, they said companies saying that they heard from customers that sometimes they would love to shop ultra low price products, even if it means it might take 1 to 2 weeks to arrive.
1 to 2 weeks?
If
Wow.
you want to wait for the good deal, the low price stuff, that's what you might have to sign up for.
Yeah, I've become way too addicted to like push the
instant?
button and get it.
Yeah. You and everybody else, I know.
Although when they would then say, you will get this between 4 and 8 p.m. today, I'm like, that's okay. That's a little too much. All right, our next trending ticker is AMD, Advanced Micro Devices. The chip maker announcing it's going to be laying off about 4% of its workforce. That's about 1,000 employees as it directs efforts toward developing AI chips in a bid to compete against its industry rival, NVIDIA. AMD is planning to start mass production of a new version of its artificial intelligence chip called the MI325X. That'll be in the fourth quarter of this year. The payroll slash could save the company some $200 million. And indeed, AMD's stock price has been lagging behind.
Yeah, this one's interesting. So it sounds like the cuts, by the way, where they're going to be focused, mostly on sales and marketing positions for areas such as consumer PC, gaming PC. That is per sources cited by Bloomberg. And important to note also, apparently, still hiring overall.
Yeah, it's interesting that they wouldn't just migrate those people over to the AI marketing and sales, but
well, all in on AI now. That's
I
Lisa
guess-
Su
I
taking
guess
on
so.
Jensen.
Yeah.
All right, let's get to another trending ticker here, Rocket Lab. That stock is surging today. Look at that, 35% after the company reported better than expected third quarter results late Tuesday. So this one, by the way, so this is the biggest intraday jump since March 2021. The revenue outlook better than what analysts had penciled in. Management talking about how achievements for the quarter included signing a launch service agreement for multiple launches on Neutron with a confidential commercial satellite constellation customer.
you know what I'm going to say when I see a gain like this. 15.5% of its float is shorted, so a little bit of a short
Look at
squeeze
that move.
here for sure. But yeah, everybody's talking about the Neutron or the rockets that they are Electron, not Neutron. Electron, the rockets that they are targeting, the Neutron and the Electron. They're both. I'm getting all my
It's all very
atoms confused here, but it seems like that's where the enthusiasm lies. There's another company, by the way, AST Space Mobile, that is also catching a bid off of this move upward.
Company did note apparently that they continue to see strong demand growth for our backlog. They called that 1.05 billion. That stock chart pulled back year to date. What a move.
Yeah.
All right.
Big one.
Coming up, Elon Musk, Vivek Ramaswamy will lead a push by President-elect Trump to make the government more efficient. More on what the move could mean for government agencies when we return. President-elect Donald Trump announcing billionaire Elon Musk and entrepreneur Vivek Ramaswamy will lead a new Department of Government Efficiency. And joining us now to discuss all this is Gautam Mukunda, Lecturer of Management Practice at the Yale School of Management. Gautam, it's always good to see you. So Department of Government Efficiency, Gautam, how successful do you think this new department will be? How should we think about and define success?
So thinking about defining it, the standard that Elon Musk has set for us is that he believes he can cut $2 trillion from the federal budget annually. Let's just put this in perspective. Non-defense discretionary spending, so everything that's not Medicare, Medicaid, Social Security, including defense included discretionary spending. So everything the U.S. government does that is in some sense optional is $1.7 trillion a year. So to get his target, he's going to have to zero out defense, the Department of Energy, Department of Education, and then to cut $300 billion out of Medicare, Medicaid, and Social Security. I don't know about you, but that doesn't sound to me like he's going to hit his target.
Well, listen, Gautam, we know that Musk, at least when he's talking about Tesla, we should take him seriously, but not literally when it comes to his targets. That's gone for his companies too. You know, he's delayed a lot of stuff, whatever. So, okay, so let's say in theory, he takes more of the Twitter approach to government, right? Where he goes in and sort of gets his hands dirty, so to speak, and says, oh, you know, $400 toilet paper, no, thank you. You know, this plane is way over budget. Why are we doing this? You know, could we envision that kind of a scenario?
I mean, I hope so, in the sense that, look, government procurement desperately needs to be reformed. I used to say that my major contribution to the Navy back when I was advising was making sarcastic comments about the debacle that was the F-35 program. So great, let's try and fix those things. The problem is that it doesn't actually add up to that much. The U.S. government at its base is a highly efficient check writing operation that also happens to own a very large army. That's really the way you should think about the budget. So the big numbers are not in the places where you can cut. If he does, then takes the Twitter approach, as you put it, which is sort of what I imagine he's thinking. There's just a few problems. So one is the Department of Government Efficiency has no staff, no statutory authority. So think about the cabinet secretaries who Trump is going to appoint when these people come in and tell them, hey, you're doing your job so badly, we're going to cut your budget by a third. My guess is they won't respond to it that well, and they don't actually have to answer to these two. The second problem is that the federal government is not, a social media company. So there are a lot of things that the government does where failure is not, you get it 99% of the time. It's where you get it right 100% of the time. Think about it like managing nuclear waste. The Department of Energy manages all the spent fuel from American nuclear power plants or from American nuclear weapons manufacturing. The number of acceptable nuclear waste accidents is 0. That takes an enormous amount of technical skill and a lot of people who have a lot of institutional expertise. And if you just get rid of half of them, you can get lucky for a long stretch of time, but eventually you're going to have some problems there that are going to blow back on you in a little bit more spectacular way than having bots on Twitter. You just have a sort of an endless number of examples of that. And of course, all of these are also jobs that members of Congress are going to getting worried about, because some of them are going to feel either directly in their constituency or in the services of the constituency. So, I mean, I think trying to make the government more efficient is great. This strikes me as a pretty odd way to do it.
At the same time, Gautam, I just wonder, the politics of all this. This is a Republican sweep. I mean, called by CNN and NBC News today. That they say Republicans held on to the House. I'm just wondering, do you think if there was going to be cuts made, is this sort of the kind of almost rare, unique window Republicans have where you could do it? You could see these kind of spending cuts.
So this isn't the first Republican sweep, right? We also had this in the first Trump administration, and we didn't see these kinds of cuts. Look, the people around President Trump, the President-elect Trump, and seem to be much more willing to do these sorts of things. I suspect that they very much want to try these kinds of cuts, and it wouldn't shock me if they get some of them through. What I'm predicting is, one, that it won't be 50 or 70% cuts, the sort of cuts they're talking about, just because of what will happen, because of the pushback that will be within the government. But also, if they do get these cuts, there are going to be a lot of Republican congressmen who have their eyes on the 2026 elections who are not locked in, and they're going to get very worried very fast.
People are affected by some of those cuts, after all, and some of those people are constituents. Gautam, I want to switch gears and ask you as well about an op-ed that you wrote for the New York Times, where you talked about, for example, some of the picks that we've learned about on the part of President-elect Trump, Senator Marco Rubio, for example, for Secretary of State, Michael Waltz, National Security Advisor, and sort of try to extrapolate what that could mean for foreign policy. Now, for our purposes, I want to talk about China specifically because that's where investors are most focused, right? What do you think these picks tell us about what could eventually happen with tariffs and trade relations?
So, so far, the consistent pattern across all the picks seems to be people who really, really want to go in hard against China and really ramp up sort of everything from tariffs to foreign policy tensions to sort of national security competition. That's a consistent pattern, but I also note there was a pattern in the first Trump administration, right, where he used his sort of appointees as the bad cop and himself as the good cop, so he could say, oh, well, I'm going to pull us back from the brink over and over again. I don't know if he's going to keep trying to do that, but he did do that before. Where I would be most sort of thinking about the focus is trade conflict, things like that. That's one thing. You know, countries have trade conflicts all the time, and while that would be a hit for the U.S. economy and for the Chinese economy, we're both big economies. We'd survive it. A real national security conflict with China involving force, that's a whole different set of risks. Any conflict between U.S. and China would, this is not hyperbole, be the worst thing to happen since the Second World War. And that's if the conflict is just a small one, not the worst case scenario. So everybody involved, I hope, will get very, very careful very, very quickly if they start pushing that to the brink.
Gautam, always great to see you and to have you on the show. Appreciate your insight.
Thank you.
Now let's get to some calls of the day. Evercore ISA downgrading Caterpillar from in line to underperform. The note highlighting Trump's second term in office. So actually, Evercore, they took out the red pen here on a few name analysts. Downgrade Caterpillar, Eaton, Illinois Toolworks, ESAB. This comes after Trump's win. The team likes small and mid-cap stocks more, apparently, those with domestic exposure over those global players where they don't think valuation looks so attractive.
So it looks like a combination of things, but sort of this relates to the conversation we were just having as well, right? That are we going to see a ramp up in trade tensions? Are we going to see it tougher for some of these big multinational companies that are based in the United States? And what is this going to mean for commodity prices as well, and how that feeds through for some of these companies? So Caterpillar, Eaton, Illinois Toolworks, among the companies that got downgraded by Evercore in this call.
Yeah, they also said that commodity price weakness suggests, they said not so fast or not so easy, given machinery stocks, organic sales growth, and EPS are highly correlated with commodities.
Right, exactly. So we'll be watching both of those very closely. And also we're watching Snowflake. That company had some product updates and held a conference. It was an event called Build, and that's sending the stock higher today. A lot of analysts coming out and commenting on that, and they were happy about the event. They thought it was positive. Also keep in mind, the company has a new CEO since February, so part of the commentary centered around a little bit of optimism about his leadership now of the company. Yeah,
KeyBank is encouraged, they said, by continued progression of the AI roadmap. Truist, they also like this name, sees the investments they've made in the AI product over the last years driving a more competitive offering. It has not been easy being long this name this year. The stock is down hard, but most analysts who cover it say stick with it.
Yeah, the stock climbed to the highs of the year after that CEO appointment, and since then have fallen, as we saw there.
All right, moving on. Pagaya beating some estimates for the third quarter yesterday, but the stock took a hit after reporting a wider than expected loss. Here to walk us through the report and talk about the lending market more broadly is Pagaya CEO Gal Krubner. Gal, it is good to see you. So let's talk with this print, Gal. Start there, because you report this larger than expected $70 million charge. The stock took a hit on that. I think what investors are trying to figure out, Gal, is this about credit deterioration, or is something else going on here?
So it's a great question, and I think very relevant to all what we are seeing and expecting in the market. The reality is that these type of charges that we saw coming on the balance sheet of us right now are actually from transactions and things we did in 2023 that are maturing these days. And in 2023, there was a very high cost of capital in the capital markets. So when you think about it, the cost of capital to actually finance consumer lending businesses was very high, and therefore these losses are coming in today. But the more important question, as you asked, is what is the health of the consumer today? And the reality is it's very strong. Because both performance, and we spoke about the cumulative net loss that we saw in Pagaya, they were actually becoming lower and lower since 21, the COVID years that were very tough for the consumers from the inflation that we saw and the high interest rate that came up. But the reality is with the Fed coming in and helping the consumers, and in the same time, flow of funds is becoming much easier in the capital markets, spreads are going down and things are becoming much more stable, definitely we should expect a better environment for the consumer credit moving forward.
I just want to linger on this on the charge for a little bit longer. Can you explain to us a little bit more the technical reasoning behind that?
So when you are thinking about creating consumer loans, the way usually people are financing them is through the capital markets. And if in years like 2023, where you have a very high benchmark rates, and in the same time, very high spreads in the capital market, that people are willing to finance these assets at a very high cost of capital, the return that you need to hit in order to bring them are very high. So what you see right now is the seasoning of these assets that are coming into play with a very high cost of capital of the transaction that have been closed to finance these assets that are impairing what is being left on the balance sheet from that spread. And that is really the driver of what we saw in Q3. But the more important piece is that when you think about the future and how these asset classes are performing, they're actually performing very well for many reasons. Part of it is lenders like ourselves and others shrink their box. From other reasons, which the Fed, as we spoke, new government that speaks very highly about growth and initiatives like that. So when you think about the outlook, which is more important for the sector, is actually very positive to where it is today.
I was talking to an analyst today who covers you all, and he was saying, ultimately, Pagaya, it's a network, right? It's a two-sided network. He's got banks, he's got investors, and he was making the point that we have seen in the past some real debacles in networking-based platforms. Why are you all different?
So I think the interesting part about the difference is really the fact that we are serving a very big need of the consumer credit. At the end of the day, because of different regulatory regimes, the ability of banks to actually lend to a very big variety of Americans are much lower than people expect. So we are in this connecting piece that bringing capital, private capital to the game and trying to help Americans get the credit that they need. Now, the reality is that we are working with SoFi, US Bank, Klarna, which is just today spoke about filing for IPO, and many others, seeing a very wide range of data. That data is giving us a very unique advantage to be able to provide that consumer with the right credit that they deserve. And the things that is behind that is that there is a very big need. We're talking about 2 million customers that we have provided them loan of $24 billion in only the last few years. So bringing all of that together, there is a very clear initiative and ability to help consumers and the lenders that we are partnering with, as I said, US Bank and others, to help them serve their customers, which is a growing need as we see in these days.
Now, I don't know if this makes sense, but one of the assumptions with this incoming Trump presidency is that regulations will loosen for banks, capital requirements, for example. Does that jeopardize what you're talking about at all? In other words, will they be able to lend to riskier borrowers, for example? Will that take a chunk out of some of your partners' businesses?
So what we are most excited about from the tailwind of these pieces is the ability of banks to collaborate with AI and more sophisticated underwriting tools is actually going to be better. And the way we work is we are embedding ourselves into the bank systems. So the more willingness of the government, potentially, as investors say, to help these type of technologies enter into the financial system and to help consumers, that's exactly where we are coming from. At the end of the day, it doesn't matter if it sits on the bank balance sheet or the capital market balance sheet. What it matters is to make sure new technologies are going to help consumers to get the loans they need. And that's where Pagaya is getting a very strong tailwind, especially with the banks that we spoke about.
Always good to see you on the show. Thanks for joining us.
Thank you
Appreciate
so much.
it. Up next, Disney earnings on deck tomorrow. Ahead of the open, we've got to look at what to expect. That is straight ahead.
What do you think about the thought of the death of cable news? Is that greatly exaggerated as you look 5, 10, maybe even 15 years out? Is that a reality?
I think it's like the death of radio, right? I think it will absolutely decline. Mm-hmm. The sub fees will decline, and that's why you're seeing cost cutting. I think there's a floor. I don't think that one day you're going to wake up and there's 0 cable subscriptions.
That was former CNN Worldwide Chairman Chris Licht speaking with Yahoo Finance's Shauna Smith at Wednesday's Yahoo Invest Conference. Now, Licht's view is the same as many others. There'll be a bottom for cable, but no one knows if it's arrived yet or how bad it'll be when it finally gets there. Joining us now, Robert Fishman. He's a guy who's thought a lot about this. MoffettNathanson senior analyst. So, Robert, you heard what Chris Licht had to say there, like sort of likening this to radio. Where do you think we are in that cable cycle?
Yeah, thank you. So I guess there's a couple different ways to look at this, both from the distribution standpoint and then from the advertising standpoint. The radio analogy one we've actually made as it relates to linear television advertising, because we do think that that is going to continue to come under significant pressure going forward as the eyeballs continue to shift to the connected TV and streaming landscape. But as far as the distribution goes and figuring out where the pay TV floor is, we are getting increasingly worried about where that floor really is as a lot of the sports rights continue to go over the top and allowing people to not view the exclusive sports within the pay TV bundle.
Robert, let's switch gears and talk about Disney. I know you have a buy on that name. You're a believer, Robert. What are you looking for when they report?
Yeah, so I guess Disney wraps up media earnings for us tomorrow. We're expecting to see much better profitability on DTC, which is, I would say, a takeaway across some of the other media names that we've seen so far to date. We're also expecting to see a much better studio performance given the hits that they've been continuing to make there and coming out of some of the lull that they had post-pandemic. So we're excited to see the profitability return at the studio. And I'd say investors are very much focused on the parks as well in terms of some of the more challenging comps they have next quarter. After they finish reporting September quarter, we'll start to see some of the impact around the hurricanes hitting their numbers. So that's their Q1 fiscal calendar year. And then really going ahead, thinking about 25, it's going to be about how Epic at Universal might impact on the parks. But overall, we feel that the parks are a very strong asset for the company that don't get fully appreciated.
Robert, I want to zoom out once again here because we're about to get these Disney numbers. We were talking about the weakness that we are seeing in the cable companies, and we are, of course, approaching an administration in Washington that is at least expected to be perhaps a little friendlier to M&A. So given the strength of some media companies versus others, given the weakness in some sectors of some media companies versus others, what kind of moving around of the chess pieces are you expecting?
Yeah, it's a great question. Clearly, there's a lot of moving pieces as we think about media M&A and who can play into that. The obvious, what we've seen so far is Paramount being acquired this year. We've got some larger transactions in the past around Disney and Fox, 21st Century Fox creating a standalone Fox today. And then obviously Warner Media as part of the Discovery deal. So there's still a lot that can still trade hands, if you will. We are expecting more consolidation in the future. But I think all paths lead back to streaming here and where this industry is going. We did get the comments from Comcast that they're looking to explore a cable network spinoff, but really our focus is on how some of these standalone streaming services can continue to operate independently or if they need to join forces with others going forward.
Robert, finally, let's talk Netflix. Hey, listen, you got Tyson and Jake Paul on Friday, Robert. I don't know if you're going to be watching, but you might be excited about that. You're not excited about the stock, though, Robert. You got a neutral on there. How come?
Well, we are excited about the match, and yes, we have been on the sidelines for Netflix. We're very excited about the fundamentals of the business, but we just can't get there on valuation given where it's trading today relative to some of the other names that we do cover. But as far as streaming and the streaming wars, I mean, it's very clear that Netflix has won that war, and we do think that some of the future growth might be a little bit less than what some of the bullish expectations are out there, but we are very excited about the fundamentals of that company.
Robert, good to have you on the show today. Thanks for joining us.
Thanks.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day. Not much change, but a little bit of change here, and still what sort of seems to represent a little bit of a pause continuing from the monster rally that we saw last week. The Dow up just about 47 points, about 1/10%. The S&P 500, very little changed here, and the Nasdaq down about 1/4%. As we were talking about earlier, the Russell 2000 underperforming a little bit today. So, Jared, feels like the stalling of momentum sort of continuing today.
Yes, and absent any declines, though, really not a case that we need to worry about anything. And we can look to some other indicators here that kind of support that case that fear is getting priced out of the market. Here is the VIX. VIX is down 13.8, so a 13 handle, pretty bullish generally for stocks. Dropped below 15 just the other day. And we can also see that in the MOVE index. This is like the VIX for the bond market. And we can see since the election, there's been a big drop. We've got a little bit of a bounce here, but for the most part, the 10-year T-note yield has been just kind of trading, I was going to say sideways. It's up at a high. It looks like it closed at a recent high here. So yeah, that is a recent high, 4-month high. So the bond market has been hedging higher, but volatility has been muted. I think that's an important observation to make. And today we see a bifurcation in tech. We see consumer discretionary, which has a lot of tech stocks in it, like Amazon and Tesla. That was number one, up 83 basis points. Tech itself, XLK down about 1/3%. Also seeing energy and real estate up about 8 basis points, and healthcare and utilities in the red there. Let's go over to the Nasdaq 100 and just take a look at, see how the mega caps fared today. NVIDIA was very close to another record high, did not make it, down about 1 1/3%. Amazon, we were talking about XLY, that's up 2.5%. Let's show the 5-year chart so we can see this recent breakout, giant cup and handle, and then breakout here that we saw just over the last few weeks. And consumer discretionary itself looking very much the same way. We did not see participation in well, this is actually ARK Innovation, so I was going to go here too. Coinbase down 10%, Hood down 3%. So we saw a little bit of red in ARK, but I was going to go to semiconductors where we're seeing a lot more red. AMD down 3%, so is Texas Instruments down 3%, Micron down 4%, ADI down about 3%, Intel bucking the trend, that's up about 3.15%. And just for fun here, let's take a look at software where we can see the opposite story. A lot of green here, Atlassian up 3%, Shopify 5%, and that kind of ties into consumer discretionary, and Adobe up 1%. Josh.
Jared, thank you, buddy. Markets post-election rally starting to fade out a bit. Stocks little change on the day, and joining us now is Dan Griffith, Huntington, Private Bank Director of Wealth Strategy. Dan, always good to see you.
Thank you. Glad to be here. Thanks for having me.
So when you're talking to clients right now, what is top of mind for them, Dan? Are they talking, is it Trump? Is it Jay Powell? What are they asking you?
So definitely interest rates continue to be something that they're asking about, but most of the questions I've gotten in the last week, as you indicated, are about the election. What does this mean for taxes? And what's that going to mean in the future? Are we going to see something different? How serious is that going to be? And it feeds into a lot of the concerns that our business owners have had for a long time, but it's something new to talk about.
What do you tell them, Dan, when they ask that?
Well, we obviously think that there is going to be a different tax picture than we thought there was going to be last Monday, without question. Obviously, right now, under the current legislation, there are some scheduled tax cuts that are going to be really significant at the end of 2026 because the Senate went the way that it did, and it looks like the House will go the way that it did. We think that probably a lot of those tax cuts will go away. But here's the real question. We still have the deficit out there, and the budget rules are still in place. Which ones are going to be picked? If Trump moves forward with the, for example, limitation on no taxes for tips, is he going to make changes to the estate tax exemption as an example? So we still think there's going to be some horse trading that'll go on, and that's what a lot of our business owner clients are asking about right now.
Yeah,
where am I going to end up?
I mean, tax on tips, if they get that could affect their businesses, for
100%.
example. So I'm curious, you always see what they call sort of window dressing or changes at the end of a calendar year as people try to position for taxes. Is that different at the end of this year because there's so much uncertainty? And could we actually see it affect the market? What do you expect on that front?
I think for a lot of business owners, Julie, that one of the issues that comes up is that people are concerned right now about what they should be doing with ownership overall. A lot of business owners are in a situation right now where they're saying, I think I want to sell in the next 5 years. And so what they're partly trying to do is pick and time, not just when their balance sheet is going to look solid enough to get the best purchase price, but they're also trying to time what that's going to look like from a tax hit standpoint. And so what we find is that in the recent survey that we did of small to mid-market business owners, almost all of them said, yeah, we plan on selling within the next 5 years, but very few of them have a succession plan in place. So they don't have advisors who are going to be able to actively and proactively help them do the analysis to work on that. And that's what we've been trying to help people with.
Dan, another issue obviously in front and center is yields, the moving yields. When you're talking to clients, they ask you, are yields moving higher? Is it because of good reasons, because the economic data has been coming in better than expected, or is it tariffs, inflation? How do you see it? What are you telling clients?
Well, we think that there's a number of factors there, all of which are very relevant. I think interest rates longer term, are obviously going to come down. We think there's going to be the Fed will cut in December, like many people do. Obviously, with the news today, that the chances of that continue to go up a little bit too. But what we're looking at when it comes to earnings on one side, or just interest rates from a fixed income standpoint. Both of them look to be pretty solid at this stage of the game. And a lot of our clients are saying, we're in good shape. One of the unique situations that we face is that a lot of our business owner clients end up selling their business and they have a huge pile of cash and they're asking us kind of a similar situation. Do I engage that into the market? Do I hold that? Do I put it into fixed income? What should that look like? And so we're having those conversations very actively. We think people can get good yields in a lot of different areas. There's a lot of reason to be optimistic.
Let's talk about some individual stocks as well that I know that you like. And it's interesting because there's sort of a mixture of slow and steady and like more growthy, I guess.
Yes, we like to throw a mix at you, right?
Yeah, so Qualcomm is one that I watch closely in particular. It's not had a great year relative to its peers. So why would that be one that you're looking to get clients into right now?
I think there are two things about it that are really compelling. One of them is that they obviously are focusing on the higher end of the market, and so the margins that they have are, I think, really helpful. The second piece that I think is compelling about it is they've really kind of been agnostic when it comes to the Apple versus Samsung debate. So if you think about, which phone is going to win or come out on top or is going to be cool one way or the other, they win either way. And so that's one of the areas where I think longer term they're going to be something that's going to be compelling. And we see there might be a buy opportunity today.
What about Lockheed Martin, Dan? That's an interesting name. Now, is that a bet just on general defense spending environment?
Well, we think actually, there's a lot that goes on there in a broad kind of macroeconomic standpoint. As you mentioned before, there's a lot going on in the world where, unfortunately, that's the kind of spending that's needed. But there's some specifics about that stock in particular that we think, that are compelling, including the fact that they had a delay on a number of their F-35 awards for 2024, and so they're going to be delivering a ton of those in 2025. So we think there are some reasons why, not just like overall schematics are going to be helpful there, but some specifics about that company that are going to be helpful.
And then Verizon is another one that you are looking at here. And that's another one that's like,
right,
not growthy, I guess you could say.
No, a lot of our clients are really excited about it due to the dividend. Obviously, that's one that people really get excited about. But they've also done a really good job with their core organic business. They focused on normal, regular growth, and they've had some success there. And sustaining the dividend, I think, is a reason that a lot of people look at that and say, okay, that makes sense. And then longer term, they've really worked into some of the sectors that some of their competitors have begun to work into, like home internet and other areas like that. So we think there's still some upside there. And their commitment to the dividend makes it so that a lot of our clients are willing to take that bet.
Gotcha. Dan, good to see you. Thanks for coming in.
Thanks for having me. Yes, glad to be here.
Got to get some breaking earnings news now from Cisco. Those shares, I should say, are down a little more than 1% here. That's even after the company raised its full year forecast. If you take a look at the fiscal first quarter numbers here, earnings per share 91 cents versus the 87 cents analysts had anticipated. Adjusted gross margin coming in ahead of anticipations at 69.3%, and revenue, it looks like for the first quarter, $13.84 billion, that too ahead of estimates. The company is saying full year revenue will be $55.3 to $56.3 billion. It had seen 55 to 56.2, so raising the range of its forecast a little bit here. But again, the shares weakening a little bit.
And this is another name. It had enjoyed this really strong run since they last reported. That was middle of August, and bulls have been sort of betting Julie broadly on a couple of things. But one is it has been this bet on a recovery in the networking market, and if course, if you saw that, Cisco, you would think of as a prime beneficiary. Just looking over comments from the C-suite, you see Chuck Robbins, the CEO, sounding an optimistic tone here. He's talking about a strong start to fiscal 25. He talks about how his customers are investing in critical infrastructure to prepare for AI. And with the breadth of our portfolio, Robbins saying we are uniquely positioned to capitalize on the opportunity. I think you'll hear, obviously there'll be a lot of questions about the networking market, what they see now and ahead, also cloud networking, the Splunk integration, any execution there, or is that going according to plan? And security, we know, some analysts also see that as a real wild card. That's another kind of critical watch point, some on the street argue.
Yeah, it's not entirely clear why the stock is trading lower here, but presumably we'll get a little insight. We can glean from the questions that people ask on the call what they're zeroing in on.
And you know who else we can ask?
Yes.
Scott Herren, Cisco's CFO, is going to join Madison Mills and Shauna Smith. That's on Catalyst tomorrow at 10:30 a.m. Eastern. Well, shares of SoundHound AI, they are plunging today. More on the company's latest quarter that is coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
SoundHound AI delivering a narrower than expected loss for the third quarter and topping revenue expectations. The company also lifted its revenue outlook as it broadens its target markets. The CEO of the company of SoundHound AI, Keyvan Mohajer, is joining us now to discuss this and what's going on with the company more broadly. Keyvan, thank you so much for being here. We've been looking through the numbers, and we've also been looking at the stock reaction that we saw today. Now, a couple of things like your margins deteriorated a little bit year over year, but what are you thinking as you look at that reaction today?
Thank you for having me. We had a great quarter. We are really proud of our results. It was a record quarter. It was a comfortable beat and raise. We crossed revenue 25 million for the first time. That's up 89% year over year. We also entered some new verticals that we're really excited about. I think, we think long term, and if you look at, the last 5 days, the stock has gone up, and, if you look at the whole year, we are up almost 3x. I think there's a lot of good material in our remarks that people have to digest, so we are going to wait and see, how the reaction pans out. But on your comment about the gross margin and so on, so we had some acquisitions, and there are some short-term temporary impacts on our gross margin and costs. For example, the companies we bought, they have their own clouds. We have our own cloud, so there's some duplicate costs there. They usually use the third-party APIs for AI models. SoundHound has its own AI model, so once we migrate those, we should get the cost saving and also improving quality. So those should improve over time.
One thing, Keyvan, you all talked about was how you continue diversifying your customer base. Talk to us about that trend and also just how you're allocating resources there.
We spent more than 10 years just in R&D, so build our own AI models and voice recognition and in dozens of languages. And then we started monetizing it. First, we were very big in automotive, and then we went to AI customer service. And our vision was always to diversify. So when we went to AI customer service, we said, let's go to restaurants first. And we said, restaurants to us are what books were to Amazon. So Amazon was a bookstore, and then now they sell everything. So we want to be in all the enterprise brands. So we are in millions of cars, we are in millions of TVs. We are the #1, I believe, AI leader in AI for restaurants. But now we are in healthcare, we are in insurance, we are in financial institutions, we are in governments, we are in retail. And some of that has been organic growth, and some of it has been through our acquisitions that have accelerated. And that has been a big improvement, because if you look at year over year, we used to be 90% automotive. Now we are in under 25%. Also, customer concentration has improved. We used to be 72% last year, came from one customer, and that was an area of weakness. But this year we had only 12% was the largest customer.
And Keyvan, just to dig a little specific here, give us some examples of how exactly your technology is being used by some of this expanding client base.
So we power devices, and we power the customer service for businesses. For devices, think about cars and TVs, and eventually all IoT devices. We think people will ultimately prefer to speak to devices. We are familiar with that in automotive, because when we are driving, we don't want to take our eyes off the road. But we think eventually all the IoT devices will have, all they need is a microphone and a partner like SoundHound. And then the preferred interface becomes voice and conversation. So we provide this branded digital assistant to devices, and that's one pillar of our business. The second pillar is AI agents for customer service. So when you call a restaurant to place an order, our AI picks up the phone. When you go to a drive-through, instead of talking to a very busy person who's also making the food, and you talk to our AI. And we also omni-channel, so mobile apps, chatbots, and so on. We think AI agent for customer service is really the biggest near-term opportunity for generative AI, and SoundHound plays a big role in that.
In terms of that speech recognition, Keyvan, you have that technology actually in-house. I'm just curious, how does it actually compare and contrast to what big tech offers?
Yeah, actually, there are very few companies have their own speech recognition in-house, and some people don't know that because there are APIs out there. But the source of the technology is only a handful of companies, and SoundHound is one. So we're very proud to have our own speech recognition that we've developed over 2 decades in dozens of languages. We've trained it on millions of hours of audio with billions of real queries. We benchmark that against the big tech APIs, and we consistently beat them in accuracy and speed.
Kayvon, I also want to ask you sort of the latest in our continuing dialogue about the effect of AI on the workforce. And we got some really interesting comments on this point from Arvind Krishna, of course, the CEO of IBM. He spoke at our Yahoo Finance Invest conference yesterday, interviewed by our Shauna Smith. And I want to play for you what he said about this issue.
Birth rates have come down. If birth rates have come down, there is going to be a lack of people on the globe, put aside the US. So we all have to learn how to leverage technology to do some of the jobs that people used to do in the past. I think there's no way around that.
So I think he was trying to sort of, debunk this idea that AI is taking people's jobs. He says, with birth rates going down, we need AI to do some of these jobs. I'm just curious what you think about that.
I think there's going to be a disruption, but I think it's going to be net positive. So there's going to be more work created. I think we are going to be the pilots. People talk about co-pilots, and they say, what's going to happen to humans? We are going to do pilots, right? So what happened to the Industrial Revolution? We used to work in farms, and then the machines came, and now we drive those machines. Now the AI is the machine. So people are going to be the pilots of the AI to do good things. I think that's great.
Kayvon, always a pleasure to have you on the show, sir. Thanks for joining us.
Thanks for having me.
Time now for What to Watch. Thursday, November 14th. Starting off on the earnings front, another batch of earnings coming in tomorrow. That includes Disney, Applied Materials, and Oklo. Disney announcing results for the fourth quarter. That's going to come before the open. Analysts expecting a downdraft of Disney theme parks, but streaming profits to rise following those price hikes.
And moving on to the Federal Reserve, we'll be getting some more Fed commentary throughout the day, including from Fed Chair Jay Powell. Investors will listen closely for clues about the Fed's next move after it cut interest rates by 25 basis points at November's meeting.
And taking a look at the economy, monthly PPI data, that's the Producer Price Index, coming out in the morning. Economists forecasting those numbers to tick up month over month to 0.2% and 2.3% year over year.
And finally, we'll be getting weekly mortgage rate data from Freddie Mac in the afternoon. Last week, the 30-year fixed rose to 6.79%. That marked the sixth straight week of increases. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here's some of the trends we're going to be diving into. The election-fueled rally starting to show signs of fading. The major averages closing the day little change here as investors digested the latest inflation reading, but one of the big movers on the day, Bitcoin. We've got to look at the trading day takeaways. That's straight ahead. Drill, baby, drill. President-elect Trump's win cheered by big oil and gas industries as they anticipate a friendlier regulatory environment. But will that translate into a surge in stock prices? We're going to discuss that straight ahead with an analyst. Plus, modern warfare. Silicon Valley has its sights set on Washington. Startups like Anduril are seeking to transform the U.S. military. And fresh off the heels of my conversation with Anduril's CEO, Brian Schimpf, we're taking a closer look at the future of defense technology. Well, oil and gas companies cheered President Trump's election victory last week after he promised to unleash an oil boom in the United States and target President Biden's climate policies. However, our next guest says Trump's win is not necessarily good news for energy investing in oil and gas producers. And joining me now is Stuart Glickman, CFRA Research Energy Equity Analyst and Deputy Research Director. Stuart, it's good to see you. So maybe, Stuart, actually, I'm curious to get your outlook for crude. You know, looking at Brent here, Stuart's just under 72. Where do you think that is kind of near intermediate term here?
Hi, Josh. Thanks for having me. So crude oil wise, yeah, pricing I think is going to be mediocre for 25. We're looking for WTI probably around $65 a barrel, Brent arguably somewhere close to 70. So I think we're kind of in range for what I think is going to happen next year. And yeah, I don't think it's necessarily great news for energy investors. We're already producing record oil production today, and they're, you know, I don't see a huge impetus for lots of, you know, incremental supply growth coming out next year. But non-OPEC supply growth next year is already looking pretty robust. So couple that with a kind of a wobbly demand outlook, and I don't think it's great for pricing.
In terms of upside risk to that call, Stuart, I'm just curious on the demand front. You know, how are you thinking, for example, about all that stimulus in China?
Right. So China has had several incidents now of, you know, extra stimulus they're putting into the economy. It so far has not really placated investors, and I think investors are kind of treating it as a show me story. Like, let's see what the data tell us about Chinese economic growth. And it's been kind of underwhelming the last couple of quarters. So until they kind of break out of that and show that the economy is really on its front foot, I think there's going to be some skepticism there.
And what about, of course, geopolitical tensions, Stuart, in the Middle East? Always possible that escalates. How does that sort of fit into your thesis?
Yeah, so we've been dealing with just a deluge of geopolitical crises, right, for the last, you know, call it 12 months. They haven't really found, I would say, a sustainable path towards much higher oil prices. I think, you know, where the real concern is that if you get into some, you know, direct confrontation with Iran that involves, for example, Israel attacking Iran's oil facilities, that's a different ballgame. So far, when Israel has attacked Iran, it's been really going after their military assets, their missiles, their drones, and so on. So if that were to expand, then I think that does change the picture. Or, for example, if Iran were to pull a move like, you know, start to impede traffic in the Straits of Hormuz, which is a major transit point for lots of crude oil moving around the world, that too, I think, would be very bullish for crude oil. But barring those kind of really significant events, I don't see geopolitics really driving the bus next year.
Let's bring it back closer to home, Stuart, because here in the U.S., we've got a Republican sweep in Washington. You know it's a Republican mantra, right? Drill, baby, drill. So would you now expect, should investors expect, to see some kind of meaningful uptick in U.S. production?
So I would differentiate within the U.S. between upstream on the one hand and midstream on the other. And on the upstream side, producers are already producing record levels of oil. But interestingly, what they're not doing is they're not throwing every dollar they have into the oil field, right? So for every dollar of cash flow that upstream producers are getting from their operations, they're channeling maybe 50 cents of that into new oil development. And the other 50 cents is going towards dividends and buybacks. I don't see that changing with the incoming administration. So I don't think you're going to see a ton of extra oil, but you already have U.S. oil production on the rise because of technology. You also have non-OPEC production growth coming from Canada, from the likes of Guyana and Brazil. So non-OPEC supply growth next year already looks to be robust, even if U.S. producers don't really add a ton more development spending. On the midstream side, by contrast, there's an awful lot of demand for additional midstream assets, the pipelines, the gathering assets that move those units of production from A to B. And I do think that you're going to see a drive for more of that to come. And so we're positive on midstream. It's the one area of energy that we're particularly bullish on.
And so to that point, Stuart, with that backdrop in mind, I want to get viewers some picks here, some investment ideas. One, you have Cheniere Energy, ticker LNG. Why would that be a buy at these levels?
Right. So the Biden administration early this year put a moratorium on new LNG export terminal licenses. We expect that the Trump administration is going to repeal that as one of its first efforts. And in the event that there's more LNG export terminals to be built, there's going to be a drive for more LNG. Cheniere has that first mover advantage. They already have lots of operating capacity, and they are going to be expanding beginning in next year with more spot capacity that they're going to have available to sell into that market. So I think that Cheniere, very well-run company, they typically have built their LNG terminals on time and on budget, which not a lot of other folks have.
One more name, Stuart, quickly, I know you like for our viewers to consider, Energy Transfer.
Right, so Energy Transfer, MLP, they have an awful lot of crude oil, NGL-related exposure. Both of those, of course, need that additional pipeline capacity to move those units out of the key producing regions like the Permian Basin. Energy Transfer is very good at that. And Energy Transfer also has a pending LNG project called Lake Charles in Louisiana that got stymied by the prior administration, and I think probably gets resurrected under the new one.
Stuart, great to have you on the show today. Appreciate your time, those picks, sir.
Thank you.
The post-election rally losing steam as the Dow and S&P 500 closed little change in today's trade. And Yahoo Finance's Josh Schaefer joins us now for the trading day takeaways. Josh.
Yeah, Josh, it looks like markets might be up today after this morning's CPI print. That's what I want to dig into first. So the Consumer Price Index, of course, a reading on inflation for the month of October. And what was interesting within this print, so core CPI comes in at 3.3%, in line with economists' expectations. But I want to take a look at a little bit of a different chart here. So we're looking at, of course, a lot of lines. But what we're looking at in the dotted line is the Fed's 2% target, right? Your light blue line here is that year-over-year change I just highlighted. Been pretty flat. Your yellow line starting to come down. That's 6-month trend, also flattening out though. But this purple line is starting to interest me. So that's the 3-month annual average. The 3-month annual average moved from 3.1% last month up to 3.6%. This is what economists are saying might be why, yes, the Fed might cut in December because they're already sort of on this path, right? But less cuts in the beginning of 2025.
Maybe even a pause in early 2025?
Pause in early 2025 and maybe 1 cut or 2 cuts over the first half of the year because of this trend. That's a little bit of a sticky inflation trend. Chair Powell talked about this actually last week. We don't just look at year-over-year change. We also look at the 3-month. We also look at the 6-month. And so it's interesting to see that. Sort of, I think it extrapolates the fact that we're seeing sticky inflation, a bumpy path down to that 2%.
Yeah, so maybe a pause early next year. We'll see how President-elect Trump feels about that.
Exactly, Josh.
Right,
I'm sure not happy, right?
Yeah.
But one thing that President-elect Trump has done, Bitcoin is ripping since Trump has been elected, right? Passing over 90,000 today. And Josh, what I found interesting with this crypto rally today, so we're going to click on Bitcoin here so we can see it go. I believe we got above 92,000, close to 93,000. One thing we've been tracking, though, we talked about this the other day, as Bitcoin was going up, so too were the stocks related to cryptocurrencies, right? So I'm thinking of perhaps a Coinbase. But when you take a look at Coinbase today, fell 10%. So let's zoom out, right? Let's look at the 10-day. Quite a rally, right? But interesting to see, okay, we're starting to get some of the bullishness of crypto maybe priced into something like Coinbase, which is a crypto exchange, and it's not going to be a pair-for-pair trade where, okay, crypto goes up, so all of these crypto names go up. Even MicroStrategy, which has a lot of cryptocurrency on its balance sheet, so benefits from crypto going up, not participating in that rally today. So it's going to be interesting to see as we move forward and keep watching Bitcoin press toward 100,000, what does that actually mean for equities that people can buy related to these companies? Right now, it seems like maybe we've priced in that crypto's going up. You need a little bit of a different story to start moving some of these stocks again.
Saw Michael Saylor, by the way, on X saying he's preparing the Bitcoin 100,000 party. Yeah.
Michael Saylor, a regular Yahoo Finance guest, Josh. Maybe we'll get an invite.
He's in a good mood.
We'll have to have him on live from the 100,000 party if it does happen. Takeaway number 3, this was a story I was watching today. So Swedish buy now, pay later Klarna report out that they're going to be filing for a U.S. IPO. Got me thinking, what does the Trump administration mean for the IPO market? We keep hearing about this pro-business outlook. Is that going to come true? So the backdrop, Josh, IPO market has not been great since 2021. This was your big 2021 boom, kind of tailed off, picked up a little bit so far in 2024, but generally the feeling is IPO market is cool. Could it heat up? Sources I spoke with said, probably. What's interesting is it has less to do with the Trump administration's policies and more to do with the stock market. You want a good stock market. So what we're looking at here is Goldman Sachs' IPO barometer. Any number over 100 means that it's a more positive environment for IPOs. What they're pricing in here at 137, what's really driving that, Goldman said, is actually the price of the S&P 500 and the overall valuation. The fact that we are at elevated stock market levels is what's pushing that higher. What isn't, and I know you'll probably find this interesting, Josh, is actually what's bringing it down. They feel like venture capital firms and PE firms right now don't want to do a down round from the high raising, and that was something that in 2021 help drive this higher. Right now, there still feel like some companies don't quite want to come to market because they might actually lose money depending on when you got into that investment.
Is it different push and pull here? We've also had some venture investors come on the show who've said, they actually weren't that bulled up on a big flood of tech IPOs. In part, they said because a lot of the tech companies, the tech startups have raised so much money that a lot of them have these war chests where they're kind of just good for the next 12 to 24 months.
Jay Ritter, a professor at the University of Florida who studies IPOs, told me today it's been more of a supply problem, the companies actually wanting to come to market, than it is a demand problem. He said the companies that finance these IPOs are interested. They want to underwrite IPOs. It's the fact that these companies right now don't quite want to get off the sidelines. We'll see if it changes in 2024.
Professor Ritter, one of those guys you listen to. Been in the game
Absolutely.
a long time. All right, thank you, Joshua. Moving on, and coming up, Silicon Valley has its sights set on Washington. More on how startups like Anduril are seeking to transform the U.S. military when asking for a trend returns.
Our view of this is let's do what literally every free market system has done. Let's just have the DoD be a better buyer. Buy the best tech. Show the entrepreneurs that if you build technology that actually works, that solves a real problem, we'll actually buy it. And you have a chance to actually succeed doing that at scale.
That was Anduril Industries co-founder and CEO Brian Schimpf at Yahoo Finance's Invest Conference yesterday. Schimpf talking about the relationship between the Department of Defense and defense tech startups like his company, Anduril. For more on the U.S. defense industry, we're now bringing in an expert in emerging technology who founded the Pentagon's Silicon Valley office. Joining us now is Christopher Kirchhoff, co-author of Unit X, How the Pentagon and Silicon Valley Are Transforming the Future of War. Chris, it is great to see you because you are, in fact, the perfect guy to ask these questions to, Chris. And what I'm trying to get at is, we have the second Trump administration, and I want to get your take, Chris, on how you think that could now impact the defense tech sector. How you see the relationship, Chris, between the Pentagon and these high-flying, fast-moving defense tech startups evolving from here.
Well, look, we're at an amazing pivot point. In this country, we still have two systems for producing technology. We have the military-industrial complex, which is burdened by quite complex regulations that make innovation in that system more difficult. And then we have the consumer system for producing technology, which essentially makes everything else. And Brian and folks at Anduril and the broader defense tech sector are crying out and saying, look, we are actually producing phenomenal systems that are packed with incredible technology. The Pentagon should spend more of its dollars on these systems. And they're right. And I think there's broad intellectual agreement in the Pentagon today that the Pentagon should shift more of its resources there. But it's one thing to have that agreement, Josh, and another thing to actually move the supertanker that is our Department of Defense.
And what's the challenge there, Chris? Is it a question of culture, personality? What are the hurdles?
Well, Brian, or Josh, pardon me, the Secretary of Defense may control, thousands of nuclear warheads and be next in the chain of command to the President of the United States. But if he or she wants to move more than, I think, about $10 million from one line of the budget to another, Congress has to approve it. So if you look at the amount of authority that a SecDef has, it's actually very small. And this brings us to a key point now. Is the secretary going to be able to have other allies to help reform quicker and larger than has been done in the past? Will the president actually exert leadership? Will the Congress be receptive? It takes more than just the secretary to move the department.
What about the role possibly here, Chris, of Elon Musk? Could he play a role in kind of opening up the DOJ, the intelligence services more to the defense tech community, to the startups, the entrepreneurs?
Well, I think Elon would appreciate it if we both called him the X factor in what happens next in the Trump administration. Incredible entrepreneur, incredible engineer, seems to have the ear of the president. But we should also remember history. I mean, technologists have also, for a long time, been trying to reform the Department of Defense. The first, arguably, was former Google CEO Eric Schmidt, who in 2016 took the helm of the Defense Innovation Board. He was followed, we should all remember, at the beginning of the first Trump term by Peter Thiel, who landed some of his key subordinates on the Defense Department's transition team. We now have former New York City Mayor Michael Bloomberg helming the Defense Innovation Board again. So that close association between leading technologists and the Pentagon has been happening for a long time, yet we're still not seeing the kind of reform that many had hoped for.
Another issue here I want to get your take on, Chris, venture investors, and we talk about this on this show, they made a big bet on defense tech startups. They poured a lot of money into these startups, but as you're emphasizing, we haven't seen this big swing in the Pentagon's budget to these startups. Talk about that dynamic.
So we now have north of $200 billion of private venture capital money that are backing these fast-moving venture companies like Anduril. And, it's a renaissance, right? But if you look at the Pentagon's leading autonomy initiative called Replicator, the second tranche of awards, which was just announced earlier today by Deputy Secretary of Defense Kathleen Hicks, that program is in aggregate about $1 billion, out of an $800 billion program. It's something like 7/10 of the Department of Defense's procurement spend. It's an impressive start, but is it enough to move the needle?
Also, Chris, we did see President-elect Trump, he names Pete Hegseth to head the Pentagon. Without getting your take on whether that's a bad or good move, Chris, I am interested, when we look historically, can one man, can one SecDef, how much real impact and influence can they have in changing an agency?
Well, Josh, I think what we're looking for here is an alignment of the stars, literally a celestial coming into being, where you're going to have a SecDef that has the mandate to really make big changes to the Pentagon, a president that's going to back that secretary to the hilt, particularly in taking the argument of what they want to do to the Congress. Because the Congress, we remember, is going to be the one that's going to have to move around money from one part of the Pentagon's budget to the other. In other words, they're going to have to stop spending money on something they're buying today and shift it to something they want to buy tomorrow. And politically, that's very hard, even in a situation where you have a president, a secretary of defense, and a Congress aligned.
And finally, Chris, just your take generally on the defense spending environment now that we do have this, Republican sweep in Washington. What do you see?
I mean, gosh, if you'd gone back to the Pentagon's holiday party last year or the year before and asked them today, would we be in a situation where there are 10,000 North Korean troops preparing to fight on the border of Europe, that there's a hot war in the Middle East in which technology is being deployed that us and our allies are not well equipped to defeat, that we see a China continuing to rise. These are all dramatic changes in the strategic environment that I think mean defense is going to be front and central, unfortunately, for some time to come.
Chris, always great to have you on the show for your insight and your analysis. Appreciate it.
Thank you, Josh.
And coming up, we're dissecting the weight of federal spending on the U.S. economy. More asking for a trend right on the other side. For our chart of the day, we're looking at federal spending and Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this one was brought on by our topic du jour, which is this Department of Governmental Efficiency that we've been talking about, the entity that's being created that's going to be headed up by Elon Musk and Vivek Ramaswamy. We've been talking kind of all day about what it would look like, how it might, where they might cut potentially. And so that led me to take a look at federal spending as a percentage of GDP, because this does contribute to GDP growth, the spending that happens in the government. Here's a chart of the federal spending as a percentage of GDP going all the way back many decades here. And it's pretty obvious when you see the increases in federal spending. World War II, for example, you saw that big increase in federal spending as a percentage of GDP because so much of the country's output was going towards the war effort. You saw a little bit of a spike again after the financial crisis with stimulus, and then, of course, the pandemic stimulus before coming back down to the long-term trend line of around 20%. So if you see these substantial cuts, will you see then a hit to GDP? Well, it all depends on what the other policies of the Trump administration result in terms of growth. You know, tax cuts, other types of deficit spending, where it goes. We talked to Andrew Hollenhorst, chief U.S. economist, about this issue and how he's thinking about it.
There's probably going to be a large fiscal bill that comes out at the beginning of the Trump presidency, the new Congress, with Republicans controlling the Senate, likely the House, using the reconciliation process to pass that. And it may come down to a slim majority in the House, with just a few Republicans controlling that majority. Who are those few Republicans? How do they feel about spending restraint? That may be a question that we're asking.
Right, so can everyone get on the same page in terms of spending restraint? It is mostly seen as a good thing, right? Even with that contribution to GDP, Josh. But as Andrew points out, there are still a lot of questions here when it comes to spending, how much it's going to go down, and then what's going to happen. Andrew, for his part, like many investors, is most closely watching a related but separate issue, which is what's going to happen to tax cuts. Are we going to see an extension, and are we going to see new cuts as well?
Yeah, it's interesting because of course, Musk has said he thinks he can slash, it was $2 trillion out of the federal budget, but and some of this maybe I guess you could do through EO, executive orders, but you would need Congress, Julie, to step in for a lot of it. You
would need Congress, and the ability to cut is also constrained, as we've been talking about, by the fact that some of that spending is mandatory spending. So, you would need Congress to not only sign off on a budget, but actually potentially change law to get, if he was enabled to cut more than that.
All right. Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.